General Motors dropped yesterday over 8% after reporting second quarter results, even though the company beat both earnings and revenue estimates. At the current share price of just under $49 per share, the company is valued at $47 billion. In this presentation, I will go briefly over the key financial metrics and provide a valuation context. In a separate video, I will be discussing the business. On this first chart, you can see total revenue development. You can see that second quarter revenue was down 2% year on year to 47.1 billion. However, consensus expected significantly less than that. But before we move on, just look at the trailing 12 months revenue trend. The company is down 0.4%. Always keep in mind when you look at revenue growth numbers that you keep in mind the inflation rate. So if a company grows 2% and inflation is 2%, the company did not grow in real terms, it just stagnated. So what this means here in General Motors' case, since we still have over 2% headline inflation, General Motors is effectively shrinking. But it's shrinking slower than what consensus expected. That's the first key observation. The second chart gives us already more insights. Gross profit is down 16% year on year and is down 9% after the first 6 months. An important note, General Motors includes R&D expenses in cost of revenue. And for this reason, General Motors' gross profit is understated relative to automakers which do not include R&D expenses in cost of revenue. For this reason, whenever you do any kind of, for example, gross margin analysis or benchmarking analysis, you need to adjust for that. Otherwise, your comparison or your benchmark is completely meaningless. Also note the trailing 12 months gross profit trend is also negative. It's down 4% to total gross profit on an annual basis to just under 35 billion. The next item we look at is auto SG&A. You can think of this as the OPEX base of General Motors. So this line item decreased 10% year on year in the second quarter and is down 2% compared to the last quarter on a trailing 12 months basis. The primary driver in the second quarter was that GM was spending less on advertising. And the 9% year on year decrease for the first 6 months of 2025 was driven by a combination of reduced advertising spend plus the non-recurrence of last year's voluntary separation program. On this next slide, we look at operating profit. Here we see more clearly what's going on. Operating profit is down 45% year on year in the second quarter. And the first 6 months of 2025 were down 28%. And when you look at this chart, you can see that the second quarter of 2025 at operating profit of 2.1 billion is right in line with the second quarter of 2022. So the last 2 years, there was zero operating profit growth based on that quarter. Then we take a quick look at non-operating items. You can see that in the fourth quarter of 2024, there was a massive expense of just under 4.1 billion. This was primarily driven by a China JV write-off in relation to restructuring. But by the way, I predicted in September 2024 that GM would take a massive write-off. In a few months or a couple of weeks later, they announced it. And needless to say that the stock sold off on the news. Then we move on to profit before tax. In the second quarter, this number was down 35% to 2.4 billion. And the trailing 12 months decreased 15% quarter on quarter to 7.1 billion. The first 6 months are down 19% to 5.9 billion. Here on this chart, we take a quick look at tax expenses. There's nothing too exciting. The only thing I would like to point out is that the second quarter of 2025 benefited from a lower tax provision at 481 million, which is 37% lower than the second quarter of 2024. That was 767 million. Then we look at profit after tax. It's down 34% in the second quarter to 1.9 billion. In the first 6 months are down 19% to 4.7 billion. This chart shows the net loss or income attributable to a non-controlling interest. That is a relatively minor item in GM's case. In the second quarter of 2025, this item contributed positively to shareholders of GM at 1 million, so it's complete non-needle mover. And in case you wonder why is this a positive contribution to shareholders, because it's a sharing of losses in this case. If there was income in a subsidiary that GM is not fully owning, then this would be a negative. Now we get slowly into part where it gets slightly tricky in GM's case. So now we talk about net income attributable to stockholders. And here we need to make sure everybody's on the same page in terms of the terminology. So stockholders comprise both shareholders. So shareholders are people, entities that own General Motors shares. And for example, in the beginning of this presentation, we looked at GM's share price. So those people are common shareholders. But stockholders not only comprise common shareholders, but they also represent, or include, I should say, a preferred interest. And because GM has preferred shares outstanding, there are stockholders, and then the most relevant subset is common shareholders, because this analysis is about investing in equity markets, so investing in General Motors shares or trimming or shorting, etc. So we are focused on common shareholders, not stockholders. So when you look at GM's net income, you always need to be very careful what you look at. So right now this chart shows you net income attributable to all these stockholders. So what we have to do is we have to adjust it, and this is what this chart shows you. These are the adjustments. In most quarters historically, this was not really a needle moving item because it mostly comprised dividends to preferred shareholders. But then GM reorganized Cruise, and that had significant accounting effects. And this then created this enormous volatility that you see right here. But we're not going to dive into this aspect because that would make the video way too long. And in the latest quarter, this basically returned this adjustment item back to kind of normal with just a negative adjustment of 30 million. So when you go from stockholders net income to common shareholders net income, there's only a delta of 30 million. So not really a needle mover in this quarter. Last quarter and in the fourth quarter of 2024, this was a huge difference maker. So then this chart shows you the net income that matters to shareholders. So this is net income attributable to common shareholders. And you can see in the second quarter, it went down 36% to just under 1.9 billion. And the first 6 months are down 11% to just over 5.2 billion. In the trailing 12 months, shareholders' net income is down 14% to just over 6.5 billion. But it doesn't stop here. This is the GAAP number, which includes all kinds of one-off items. So to get to a more robust metric for a multiples analysis, we need an adjusted metric. And to not introduce too much potential noise, we just go with the adjusted EPS that General Motors discloses. And to get to it, we need the non-GAAP adjustments as reported by GM. And this is what this chart shows you. And you can see here that in the second quarter, GM added back nearly 600 million, which it considers one-off in nature. But when you look at the totals for these last 3 years, so in 2022, there were one-offs of just over 2.1 billion. Then in 2023, there was just under 500 million. Then in 2024, there were just under 5 billion. So General Motors is plagued by ongoing very high one-offs. This calls into question, obviously, the very definition of a one-off in GM's case. But this video is not about that, so we move on. This chart then shows you the adjusted earnings as reported by GM. So this metric is a non-GAAP metric. It includes all the adjustments that GM believes are most suitable to create a consistent basis. And this metric most closely relates to the GAAP metric diluted earnings to common shareholders, and therefore is most relevant to GM shareholders, i.e. relates most closely to the share price. And that's why this is the best metric to use for any kind of multiple analysis in GM's case. So when we look at this number, in the second quarter was down 30% year on year, despite all the add-backs GM took. This first 6 months are down 20% to just under 5.3 billion, and the trailing 12 months are down 9% to 10.7 billion. At this point, you might ask yourself, HG said in the beginning that GM beat earnings. So how could the stock be down? And I will talk about this in a second, but before we do so, let's look at this chart. This is an important aspect in GM. This shows you the share count evolution. And you can see it has come down quite materially. And later when we get to the valuation section, I will explain why that is the case. But for now, just remember massive reduction in the number of shares outstanding. Just in the second quarter, share count decreased 3% quarter on quarter and 15% year on year. And when you look down here at the yearly changes, so in 2022, it decreased 3%, so not that much. but in 2023 then decreased 9%, and then in 2024 decreased by another 19%. But we discussed this a little later. But let's now look at this chart. This already tells you part of why the stock sold off, or a big part of it. Now you see the adjusted earnings turned into an earnings per share number. So GM disclosed $2.53 for the second quarter, and that was actually 8% ahead of consensus. So what was the problem? So the problem is down here. GM guided for full year 2025 for $8.25 to $10 per share. So when you look down here, the year-to-date reported number is already $5.31 after 6 months. This means GM is guiding at the end of July 2025 that the rest of the year will be materially worse than the first half. That was the primary driver for the sell-off. And what this looks like and what this has done to the consensus, we get to it in the valuation section. But before we move on, also look down here. So in 2024, GM delivered $10.6 per share, and now they're guiding just to at most $10 per share. So the business keeps shrinking, not only the top line, as you have seen in the beginning of this presentation, but also at the bottom line. So now let's look what this has done to the consensus. And this is what you see in this chart. Now we go into the forecast. The forecast that you see throughout this presentation is not based on my estimates. It's based on current consensus after the results release. And you can see that consensus for 2025 currently is at $9.38. This means that consensus is right now at the 65% percentile of the range implied by the guided range. So the guided range is 8.25 to 10. That implies a range of $1.75. The consensus at 9.38 is $1.13 above the lower end of the guided range. And $1.13 is 65% of the guided range of 1.75. I hope that's clear. So that 65% number tells us consensus currently is not pricing in the high end of the range, not the low end, but it sits a little bit above the midpoint. The midpoint would be 50%, obviously, and it's a little bit above that. Then when we look at 2026, this is also based on consensus. Consensus is currently at $9.66. And then the forecast in this analysis deviates from the consensus. The 2027 numbers are based on a 5% year-on-year quarterly growth extrapolation, which then obviously translates into a total 2027 year-on-year growth rate of 5% to $10.14 per share. I've used this, it's called a simplifying assumption, for two reasons. Number one, currently there are not many updated 2027 estimates available, so the consensus is quite weak. And number two, this gives this forecast a slight bias to the upside relative to what consensus expects for 2026, because they only expect 3% year-on-year growth rate. And the way to think about growth rates is always less inflation. So at 5%, if you assume we get to 2% inflation in 2027, is really just a 3% real growth rate. So very modest growth. But as usual, to make these quarterly EPS estimates meaningful for valuation work, we need to turn them into a next 12 months metric. So from today's perspective, the next 12 months EPS for GM is $8.97 per share. And this next chart shows you the next 12 months earnings. Here again, you can see the 8.97, which we just established from these 4 quarterly EPS estimates. The horizontal axis shows you from which months this next 12 months metric starts. This is different from the quarter end, because companies obviously don't report at the end of the quarter. They report a couple of weeks later. In GM's case, GM reports relatively quickly, only 3 weeks after quarter close. And from a valuation perspective, not the quarter close, but obviously the point in time where the EPS becomes knowledge of the market is most relevant to correlate it with the share price. Correlation is the wrong word here, to put it in relation to the share price. But before we move on to multiples, we need to generate a daily earnings metric, or I should say a daily next 12 months earnings metric, in order to be able to generate a daily implied share price corridor. So this chart is just a technical chart. It doesn't really do anything. It just shows you the earnings curve used for the later share price projection. This is based on the quarterly earnings that you saw previously or on prior slides. But this chart then shows you the first part of the multiples analysis. And the first key observation is obviously that GM is GM stock is trading at very low P multiples and has been for a long time. When you look at this curve, you can see that the stock only once in the last couple of years, this goes back to May 2022, exceeded 6 times forward earnings, which is very low, and only very briefly. So then these lines, red, green, and blue line, show you some last 12 months metrics. So even though they cross through the entire period that you see here, it only considers the last 12 months from today's perspective. So the dark blue line in the center is the median over the last 12 months. The median multiple is only 5.3 times, so very low. Because the multiple is so low, the standard deviation around the center multiple is also very low. So the one-time standard deviation over the last 12 months was only 0.5, and the 1.5 times standard deviation was only 0.7 times. So in GM's case, it's better probably to look at this in terms of percent around the center value. But the point is, GM is a stock on a very low P multiple. And given this long trend of very low multiple, at least at present, as long as there's nothing major changing at GM, for example, a completely new management team or something else that would significantly change the story, which frankly hasn't changed in many years, it's probably also unreasonable to assume that the multiple all of a sudden becomes, 8 times or 10 times. So this next chart is just a zoomed in version of the prior chart. Here we see sort of the recent peak and trough. So the most recent peak was in November as part of the Trump rally. But then company quickly sold off. If you remember, in December there was the FOMC meeting where the Fed cooled interest rate cut expectations, started a sell-off, and then there were a bunch of other bad news for automakers, which led to a consistent downward trend until the market bottomed in April, and then along with the market and on strong sales, GM recovered. And this is why we now touch a medium-term high in terms of valuation level. Stock is touching 6 times multiple. Here on this next slide, it's the exact same analysis, but instead of looking at the trailing 12 months median, this is now based on just the last 90 days. There's an argument that you should use a shorter period multiple to capture more the current sentiment, but there's also an argument that for a longer term outlook, you should also use a longer term historical multiple. The truth probably lies somewhere in the middle, so that's why I show you both. But in GM's case, the story is not changing significantly. So the median is currently 5.4 times based on the last 90 days, which is in line with the median that you get on a trailing 12 months basis. So let's move on to valuation. So on this chart, you now see the resulting share price corridor, share price projection based on the smoothed earnings curve that you saw earlier, plus the median 12 months multiple. The red and green lines show you the boundaries as implied by 1 times or 1.5 times standard deviation. So I put this into like plain English. The grayish fat line shows you where the stock should trade most of the time if, number one, earnings are accurate, and number two, the stock trades at a multiple as was observable over the last 12 months. So what's interesting is that just before GM announced the 2Q results, the stock, based on earnings outlook, multiples, yada yada, as I just said, was outside the normal trading range, was touching the limit as implied by 1.5 times standard deviation, which is a very rare event. And as you can see, this methodology accurately predicted a clear sell point in GM. But obviously this means that at that point when this happened, you needed the same earnings outlook. Then this slide shows you the exact same analysis, but not on the trailing 12 months median multiple, but on the 90 days median multiple, the one we discussed just a little earlier. And you can see on this, let's call it more current sentiment multiple, the stock priced now exactly to where it should be. And you can see this as this blackish line shows you the share price, and it's right basically in the middle of what this methodology would project. In other words, based on this methodology, GM's share price is currently adequately priced. But you may ask yourself, okay, what does this mean for me as an investor? And to answer that question, let's move on to the next slide. Here you can see what all this stuff means in terms of upside downside. So based on this, so this first chart shows you the 12 months median multiple, so the longer term sentiment implied projection. You can see there's so this methodology implies 7% upside over the next 1 year. That is not very much. You'd be much better off just buying the index at this point and taking much less risk than taking on single name risk like just buying GM stock. And then the medium term, so the next 24 months, price target, it would imply a 12% upside. This is also quite unattractive. So what's missing from this analysis, obviously, is that the fact that the GM base pays a dividend. So when you look at these returns, you always need to look at them on a total shareholder return basis, which is not only share price appreciation, but also dividend yield. But this is something I will not cover in this video because again, this would be way too long, too much. Video is already quite long as it is. So just purely from a share price appreciation perspective, GM appears to be rather unattractive at the moment. And then this slide shows you the exact same analysis again, but this time on the more recent sentiment multiple last 90 days median. Here, upside is a bit more, 2 years out at 18%. That's the end of this video. I hope this was helpful to put GM into perspective and also to shed some light on why the stock sold off over 8%. Depending on how GM's share price trades up, down, I will provide interim updates of this analysis to my subscribers on X to flag interesting potential buy, trim, sell, short points. I will also provide a deep dive into the business. This analysis only covered the high-level metrics, but GM's disclosure, which is actually amongst the best globally, provides significant opportunity to look under the hood, pun intended, to see what's going on. Thanks for watching. See you next one. Bye.